So welcome everybody, my name is Ryan Gibson and I'm the CIO here, co-founder of Spartan. And I just got back from the portfolio and I just wanted to kind of talk about what I saw. I rented an airplane, I flew to 5 states, covered about 2,500 miles, and I went to 15 of our properties and I interviewed all of our managers. I inspected units, I inspected the property, I visited competitors and just kind of got a feel for what's going on. And I can say for storage, I loved what I saw. There was, speaking to Spartan specifics, the properties that I went to were the Spartan Storage Fund 1 properties, the ones in Louisville, the ones in North Carolina, and the one in Chattanooga. Not quite all of them, but I went to a handful of them. And what made me really excited was we just hired a new president, and speaking to Drew's, talk about hiring the right people and the right personality and getting the right fit. We just hired a new president of FreeUp Storage, and that's our operating company. And I encourage all of you, when you're thinking about bringing on somebody to really run your business, there's a really great book called Who Not How. And so you've got to find your who's to run parts of your business and not focus on the how. Like, how do I raise money? How do I run a better storage platform? How do I find properties? How do I do that? Rather than thinking about how, think about who. Who can I hire that can do this better than me? And so that was our thought in bringing on a new president of our FreeUp Storage brand. And we just didn't go and hire anybody. We didn't just hire somebody with a couple of hours of experience in storage. We defined criteria. We wanted somebody who had managed over 100 locations under their supervision and managed it and led a team, like had direct reports. So we went all the way up to Extra Space, and we hired their VP of Asset Management. If you guys ever heard of Extra Space, you probably have seen Extra Space, but they're now actually going to become the largest self-storage REIT in the world. They're going to buy Life Storage for $12.8 billion. Unfortunately, our bid at $12.6 billion didn't land the punch. So we should have offered another $100 million or so. But no, just joking. But they're buying Life Storage. They're going to become the largest self-storage operator in the world. So we basically went to the biggest, baddest, awesomest company, and we went all the way up the food chain and hired their VP of Asset Management, and he is now our president of our self-storage operating platform. And admittedly, we kind of learned this business as we went along. We started storage, and our first deal was down in Black Diamond, Washington in 2017, and then Conifer, Colorado in 2018. And then we've now are the 40th largest operator of self-storage in the country, 30,000 units, 4 million square feet. So, we've grown this, and we've gotten it to the point where it started to become kind of REIT-worthy portfolio. So we wanted to bring on somebody who had another gear, who could go higher. I mean, we can learn all this stuff at conferences and stuff, but this guy's been doing it for 20 plus years, and he led a team of asset managers of over 15 people and overseeing hundreds. I mean, they have 1,200 locations. So this guy really knows what he's doing, and I was excited to have him join me in his first 30 days on the job and go see our properties and just what he does when he goes to a property. The analogy I give is like dropping a dog off at a dog park, and they just bolt right into the dog park and they're sniffing everything, walking around, checking every nook and corner, nook and cranny of the property, and then interviewing the manager and really challenging everything about the property. And I thought I was pretty good at value add. This guy is way above that. Just finding extra space and finding ways to reposition and then coaching the on-site staff. It was really enlightening. And I know that we buy value add deals, but this guy found a bunch of value in our portfolio that I didn't even know was there. And it was staring us literally right in the face. So I'm really excited that we've gotten somebody at the helm who's really good. The other recent hire that we have is Kevin Holst, who's our chief legal officer. So we actually went to find in-house general counsel, which is great for efficiency, but it also helps us to mitigate risk. That's the number one thing that we want to do. We want a general counsel who's highly seasoned, looking at everything we're doing, all of our agreements, all of our stuff, and making sure that we're mitigating risk for our investors and for our Spartan Investment Group. And so we went and recruited the guy from Vail. He was actually their Vail Resorts, like Epic Pass, things like that. He was their He was their chief counsel, and so we found again the best, the brightest, the guy with the most horsepower that we could find to bring in to be as part of our executive team. So when you're thinking about leveling up, right? Like no matter if you're just buying your first single-family rental property, or you're on your second or third, or maybe this is your 100th door that you're buying, level up. Like don't stop looking at local conferences for somebody who has mediocre experience. Go up a level and constantly be thinking about, am I doing something that somebody else knows how to do better? And that's been our attitude at Spartan for the last 5 years. And if I would say there's one mistake that I've made, is not doing it sooner, right? Recognizing that I'm not a self-storage expert, right? But there's other people who are. So if you're thinking about starting a multifamily shop, right, and you really want to grow out your platform, and you're running around doing all the work, that's great. I get it. You want to have your hands on. But if you really want to go far, go find somebody working for a REIT at a VP level or greater, and get them in charge of your platform, right? And there's there's so much opportunity, because they're probably hitting their peak in their position, right? They're not going to go higher. They're not going to be CFO or CIO or CEO or whatever, but they might want to grow and build something that they can make their own. And the last thing I'll say about that is, we have copies of our strategic plan around the office. We share it online. I like it. We do all kinds of really good planning. But one of the common themes that these new hires said to us because Matthias, our president, he didn't just interview at one place and go. He was interviewing all over the world. Literally, he was in Amsterdam, he was in the Netherlands, he was in Germany, looking at self-storage operators that actually operate globally. And he looked at many, many operators, and he actually gave Extra Space like a 6 months notice that he was going to leave, but find the right place to call home. And the one thing that he said, the reason why he came to Spartan and turned down other operators is because we have clarity of vision. And if you look at our strategic plan, you can see the clarity of vision. We have 3 strategic goals over the next 3 years. We just refreshed our plan. And everybody in our company, from our CEO all the way down to our store manager, knows what the vision of the company is. The mission, vision, values. They know what our 3-year strategic plan is. And in fact, we actually harass people to the point where they don't want to hear it anymore. And in our weekly meetings, we recite portions of our plan every single week, so that it's beaten into our team that they know what our vision is, and everybody's in lockstep. So if you're thinking about growing, go to our website and download our strategic plan. It's hanging out there for anybody to download and look at. It's not a secret. It's not the secret playbook or anything like that. We like to share this value. So if you go to our website, spartan-investors.com, it's right under our GRIT acronym. You can download that and see that. So, and then before we get started, we have an awesome guest who flew up from LA, Bronson. We'll bring him up in just a minute. And then Ted's going to do an interview, as he always does. Sorry to steal his thunder a little bit on the intro, but he's always got an awesome interview, which we love. But I just want to say, state of the storage industry. Our portfolio, we're seeing a record number of move-ins right now. We're seeing pricing stabilize and cap rates go up maybe 25 to 30 basis points as an industry. We're offering on everything right now. So normally we have a pretty sniper approach to things that we offer on, because we're like, if we can't get to the price, we just don't bother. We're offering on everything right now. So if it's a $10 million deal and we penciled $8 million, we're putting in the offer. And we're getting good responses. So I wouldn't say the market is softening, but I would say that there's opportunities out there where if you don't think you can get to the number, I say go make an offer. And here's another thing to think about. If you're making offers on deals and maybe you lose, right? Now they know, right, the 4, 5, 6, 7, 8 offers they had. And so if that buyer falls apart, because isn't it kind of hard to get financing right now? Or deals, maybe they're relying on another deal transacting to do that deal, and that deal falls apart. So who are they going to circle back to, right? If you're not on the table, if you haven't submitted that offer, guess what? They're not going to know to go back to you because you never bothered. So make an offer and keep that good relationship alive, because we're seeing deals circle back constantly. So I would say make offers. We're seeing a record number of move-ins. We've had, I think, we measure things on a net positive move-in. I think we've had 1,000 move-ins for the year. and about 900 move out, so we're 100 plus for the year, which is very positive. And we're seeing increasing revenue generally, we're seeing increasing occupancy, and our focus for this next quarter is to get the portfolio up to an average occupancy of 85% or higher. In storage, in multifamily, you're probably like, whoa, 85%, that's like super low. But in storage, we like to buy property and turn over the low-paying tenants. And we're okay with some vacancy because that means we've really pushed rates. So we have a goal to increase occupancy. So any questions? Maybe one question, and then we'll introduce Ted and Bronson. Okay, Bronson, Ted, come on up. Thank you.
Here we are. Okay, so hi everybody. I'm Ted. I'm part of the investor relations team and here at Spartan Investment Group. And just a quick overview of Spartan: 115 employees, 65 properties, all self-storage. We've raised $650 million. Our securities or our investments make monthly distributions to investors, and if we haven't had the opportunity to get to know you, we would sure like to get to know you. Our contact information is there, and by the way, this is being recorded and will be distributed so that you can review this later. Spartan is raising capital for 3 funds. 2 are equity funds, and there is a debt fund, pays 8%. It's bananas to me that with all that's going on in the world, that investors who are active in the stock market are not beating down the door. Anyway, it's a securitized 8%, and we've got room. On the 2 equity funds, there's a equity bump if you participate before the 1st of May. So feel free to visit our website and drill down on either the growth, either the growth fund or our income fund, which is the more conservative of the 2. Back to what Ryan said, by way of storage being strong, the chart on the screen is a tell as to the comparison of lease rates and occupancy versus GDP. And the thing that is so interesting about storage is if you think about your typical tenant in storage, they might pay $300 a month for 5 or 6 months. If your household income is about $115,000, that may be 2% of your monthly budget. Another way to say that is that's an I don't care dollar amount for the convenience of having storage. So as the economy bumps and grinds, and I wonder if we're not going to have some challenge in the next year or 2, as the economy bumps and grinds and people deal with transitions in life, storage is a recipient or a beneficiary of that. Now, I don't want to delay our superstar speaker, so let's transition. Bronson, can you provide just a little bit of context and background about yourself?
Sure, yeah, absolutely. Well, it's great to be here. It feels like I'm in the home crowd here. I'm from Seattle, so just see some great friends and family and just awesome people. Love Spartan and Ryan Gibson and just the whole thing you guys have going here, so this is wonderful. We actually run a meetup in Southern California. We have about 80 to 100 people come in every month. Ryan was down a couple months ago, which was awesome. But basically, I started really I was a well-paid medical sales professional. Making over $200,000 a year, was trying to figure out how to generate more passive income. So I learned about, I was in single family, then I learned about scaling and how do you raise money for bigger multifamily deals. So we've partnered with a lot of investors over the years. I've had 1,500 one-on-one phone calls with high net worth investors. Just wrote a book, it's not out yet, but wrote a book about passive investing. Primarily we have about 2,000 units in multifamily. And then we've got our ATM machine fund that we're going to talk about. Yeah. We've got oil and gas technology deal. We've got some car wash. So we're doing a lot of alternative things. And so I love talking about really different types of investments and really what investment classes do for individuals, whether it's reducing taxes or getting cash flow or capital appreciation or different things. So really excited for the conversation.
I can't wait to dig into that. Before we go to our next slide, I forgot to mention, if you're watching online, please do feel free to lob a question in online. Superstar Josh will get the question to me, and so as opposed to being Yeah, so lob questions in as they come up. Bronson nor I are going to be offended if you've got something on your mind, and that goes for those of you in the crowd. Okay, so thank you for the intro. Where would you guess real estate and interest rates may head, both short-term, cyclical, and then secular long-term? What's your sense there?
Yeah. So I guess I'm the superstar. Those superstars
You
around
are.
here. So I've got to just like bring it and tell you exactly what's going to happen. So close the doors and listen in. No, I think there's a lot of speculation on this. A lot of smart people have completely differing opinions on this. Good friends of mine that I respect a lot have different opinions. We were talking a little bit before. We have, my opinion really is, the Fed is really driving everything. So if you just, they say don't fight the Fed, right? So if you just kind of do what the Fed, let you know to do, okay, so they're raising rates right now. It's the multifamily volume's down 75, 80% from where it was a year ago, just because nobody wants to lend. If you're a lender and you're lending and rates are rising, you're losing money. Those long-term dated, loans that you have are going to be worth less over time. And that's why, traditional portfolios as well, stocks and bonds, if you had a traditional 60-40 stock and bond portfolio, you lost over 20% last year in a safe and traditional investment. So that's another reason for, looking at all this. But, and I would say when it really comes to it, the Fed will tell you what they're going to do, and they will be true to that, and then they will suddenly pivot. And you watch this. This is what happened with the zero interest rate strategy, is that they said, oh, we're going to stay at zero interest rates, whatever, and we're going to do it for the longer. And they had, foreseen for months, even a year, multiples later, and then all of a sudden it was very quickly they pivoted. So no matter what they tell you, they can very quickly pivot. And so just my belief is within the next 6 to 9 months, they're going to stop raising rates and actually have some slight drop in the interest rate. And I think this has a lot of implications, because as a lender, if you see that, now we're kind of at the top here, now things have started to come down. Whenever that happens, I could be a little wrong on the timing, but whenever that happens, a lot of money is going to flood it, because lenders are going to want to lend again. So it's going to be more desirable. So instead of the loan to values at 20, we used to get 20% down. Now it's 30, 40% down, right, Drew? I mean, it's much, much more down, and investor sentiment is different. Another thing that plays in with this is that there's a record amount of cash in bank accounts of Americans, like on the sidelines. So Bloomberg had an article a few months ago that said there was over $5 trillion with a T just sitting in bank accounts. And so what does that mean? It just means that that's over 4 times the amount that we've ever had. The highest was in 2020, right before COVID. So everybody's just kind of accumulated savings because of stimulus, just because I don't know what to do. The confused mind will say just to wait, even though inflation's high, people are waiting. And so what's going to happen, I believe, is when interest rates start to tick down a little bit, a lot of this money is going to flood in, and we're going to see valuations come up. So not everybody believes that, but that's my opinion. It sounds like you guys are expanding as well at Spartan.
If I could just add a tag-along comment behind that. There's a website called, USTreasuryYieldCurve.com. Again, USTreasuryYieldCurve.com. That'll show you what the yield curve looks like, and all the yield curve is a sequential yield on bonds maturing from overnight, which is the federal funds rate, to the 30-year treasury bond. Another website beyond that that can show you the options pricing for the federal funds rate, go to cmegroup.com. In the again, cmegroup.com, magnifying glass, top right-hand corner, FedWatch tool. It's going to take you to a page. Click on probabilities on the left side of the page, and that's going to show you options pricing for the federal funds rate for the next 18 months. And since SVB and Silicon Valley Bank and Signature Bank have had extreme difficulties, that bad boy has fallen literally out of bed. And by mid-year next year, CME Group, the options market is pricing Fed funds at 3, maybe 3.25. It's been wiggling a lot the last few days. So anyway, in concert with what you're saying, and for investors who have some exposure to adjustable rate loans, that CME Group FedWatch tool, click on probabilities, you can see what the options market is pricing adjustable rate. It's really interesting because that cost of borrowed funds, as you mentioned, when people look at risk assets right now, you can get 5% on your money market. Well, when Fed funds starts to collapse, and if we have a significant recession, that whole basket changes. And so for sponsors that you're familiar with, when you start an equity investment and you've got a 7% preferred return or an 8% preferred return, you know, now you're starting to cook with gas. So I went long on that.
Yeah, no, it's good. I have a comment on that real quick too, that I think right now it's interesting for people, you know, about 80 to 90% of, at least we work more on the multifamily space, of that debt is bridge debt, or it's shorter term, usually 2 year plus an extension and that kind of thing. So a lot of people wonder, well, what's going to happen and how's that going to work? And I think the people that we're seeing getting in trouble are areas that maybe really expanded very quickly, and that, you know, rents are not necessarily rising, or maybe the population isn't as much. On the West Coast in general, we're not seeing population really increase. We're seeing in California, where I live, people are leaving California, moving to Florida, and so we own a lot of stuff in Florida because, you know, when you have things like population growth or continued upside, it's very positive. And I know, so, but we were talking about this before we started, Ted, that you know, this is a time right now that anything that is owned, it's a great time to own assets, because I think in 2-3 years we'll say, man, I wish I had bought and owned more then. Right? And the challenge now is it's hard to buy stuff now. It's hard to get stuff because, and I find, you know, we raise money, at least for multifamily, I'd say it's 5 times as hard to raise money right now for multifamily. The reasons why is because you're having to raise twice as much money because of the down payment, and then investors are half as likely to give it to you because they're afraid, right? Everybody is afraid. So I think, I know this is, there's some operators in the room here, there's people that are interested in scaling a business, but I think, really, I think a lot of people, like just judging by the cash on the sidelines, are confused, they don't know what to do. I'm about 95% invested in real assets, real estate and other things, just because I see the risk of inflation being, well, we'll get into that in a little bit, but there's a risk. If you just sit on the sidelines, if inflation is not actually 6 or 8%, if it's actually more like 15%, which is what I really believe it is when you look at actual costs, then over a 24-month period, you're losing cumulatively about 40% of your purchasing power. And that can happen very quick. Even some of the stuff that's happening with the dollar now, with, you know, China and Malaysia and these countries, Brazil, they're kind of making these agreements to not use the dollar. So they kind of jumped around to some different topics, but.
Okay, so then, so cyclically, interest rates likely to come down on a secular trend. Where do you think interest rates will be 8 to 10 years from now, as well as real estate valuation?
Yeah, if I could tell you that, I'd probably I'd make a lot of money here.
It's a hot seat, isn't it?
Yeah, it is. It is. I felt like I was a superstar when I jumped in the seat, but now I don't feel it anymore. You know, that's a really hard one. It's really hard to say. I mean, if you look at historic interest rates, I think some of that, because again, if you were only paying attention to real estate in 2008, 2009, which a lot of my friends were, a lot of them lost everything, they lost their shorts, right? Because you're only paying attention to one asset. But when you're looking at the macroeconomics, I think it's very important to look at all that. And I think some big trends that are going on right now is the way that we're just spending like there's no limit. And even if you look at the budget deficit, it's expected to be $2 trillion in the deficit every single year for the next 10 years. That's just the projection. And then it'd probably be substantially higher. So there gets to be a point where, and I don't know when this is, they asked, you know, when the loss of confidence in the dollar starts to happen. It doesn't happen immediately. They asked, I think it was Ernest Hemingway, or one of these big authors who went bankrupt, and they said, how'd you go bankrupt? And he said, well, very slowly at first, and then very quickly. And then all of a sudden, right? So it's like, but watching this stuff is important, because if you're in real assets and you're watching this stuff, you know, if there's less demand for the dollar, there's so much international demand now for the dollar, even if that starts to change, it makes everything more expensive. It makes interest rates maybe higher. There's other factors that go into that, but I'm really not sure. I do know that when we were at 2 to 3%, I mean, that was they've studied debt rates for 5,000 years, and that was the lowest we've had in 5,000 years of having interest rates like these last number of years, which is crazy, right? So I don't think we'll ever see those kind of rates again. I mean, we might in the short term because the Fed is crazy, but long term, I don't think so.
Okay, thank you for that. Okay, let's pivot just a little bit. By way of inflation, help us with the prospect of using inflation to your advantage.
Yeah, so everybody, we talk a lot about this. We have an ebook on our website, bronsonequity.com, on how to use inflation to your advantage. It's a free download, but it basically, you know, we're seeing the pain of inflation. If you drive a car, if you rent anything or office space, or you're having to buy goods, you go to the store. I mean, I was at Chipotle the other day. What used to cost me like $7 is now $10, and it's the same thing. So it's just, we're seeing it everywhere. And so we're feeling the pain of that, but there are ways that you actually can use it to your advantage. And so a few strategies that we talk about in this ebook is basically getting cheap debt that's at a fixed rate for a longer term. And what I determined is I really think inflation is 15%. So I think if you can get fixed rate that's lower than that, I think you're still doing okay. If you can have it in investments that there's some leverage as long as it's wise. I mean, obviously I'm not telling anybody what they should specifically do, but one example of this is there was a time a year ago, now again you say, well, this was a year ago, Bronson, but it happened, so these things are out there. I got a 2.75% interest rate on a 100K personal loan. It was no collateral, it was like a HELOC, but there was no asset behind it. And it's fixed for 10 years. And so those products are out there where I got a long-term fixed rate and I was able to put it in a much higher return investment and use it to your advantage. Whenever you own real estate, you're typically putting 10, 20, 30, 40% down, and you're able to put a small amount down, use other people's money, and then you benefit in two ways, right? Because you're borrowing below inflation. The asset is going to be worth more down the road. It may not be in 2 years or 5 years, but long term it will be because of just the way we're creating currency and the way it goes. So it will be worth more, and you're paying it off with future dollars that are worth less, right? So some significant advantages there. One of the strategy I love is talking to somebody else about this, precious metals. I do a lot of precious metals, gold and silver, not as an investment, but just as a way to, instead of storing in cash, I buy physical metals, I have them stored at a third-party vault, and then you can borrow almost like a HELOC against the value of it, so it can give you liquidity. But I like the upside of precious metals also.
Okay, that's interesting. So what is that? Tell me more about that. So I've never seen anybody lever a physical asset such as gold or silver.
Yeah, so up to maybe 3 or 4 years ago, I really didn't own any precious metals. If you study this, and I'm not necessarily like a gold bug or somebody who's just into all this stuff, but there's a 5,000 year monetary history of precious metals being money. And even in the U.S. up until 1933, you could go in with a $20 bill, you could slap it on the counter, and they would give you a 1 ounce gold coin. And now it's about $2,000 for this, $2,100 for the same coin. But it was the dollars were just simply a claim check for the actual store of value, which was the gold and the silver. So around the world, there's a lot more investment, and if you look at what's happening with central banks, they're buying like crazy. Not the U.S., but other central banks are buying it. Russia, China, all these groups are buying gold and silver because currency, money and currency are different things. So money actually stores value. Currency, you can create as much of it as you want, right? We're seeing a devaluation of that. And I think when there's a loss of confidence in currency, of storing value, if I have 100K in the bank, I can say, yeah, I'm probably going to lose about 15K in purchasing power this year, right? But if I own gold or silver, something that's more fixed, you can't just go print more of it. And so, anyway, the question you asked was the strategy. There are these third-party vaults that you can store it at, and then you have liquidity. I don't like ETFs because they're typically levered 10 or 20 to 1. Yep. So, if there's a rush on gold, like who gets paid and who doesn't. So a lot of people will not be getting paid. But when you physically own it, you have it. You can borrow against the value of it. It's usually around 8 or 9%, but it's only for the days that you have it out. So you can, if you need liquidity, you can use it. You can pay it back. It's pretty nice.
Yeah, that's interesting. I've not seen that done in the past.
Yeah.
Okay, this is a good segue into how about from your perspective on the world, what would a broad overview of the world of alternatives look like, and maybe tailor that by way of your typical retail investor who maybe on the front end of gaining a broad allocation?
Yeah, so there was a time, now right now we consider traditional investments to be stocks and bonds, but there was a time, after the market crashed in 1929, there was an 89% drop approximately. It didn't come back for 25 years. Yep. So if you had all your money in your stocks and bonds, you would have lost, it would have taken you, and that's not even including inflation. So it would have been until 1954 or maybe 1965 until you came. So you just think about like the ramifications of that. And there was a time in there people would say like, why in the world would you ever buy stocks? So it's funny how like the marketing now is that all these things are safe and traditional, but it's because Wall Street, I used to be an investment advisor for a few years, is just billions and billions of dollars is spent teaching people that these are safe, secure assets, and they're not. It's just like the emperor has no clothes, but we can't but why is it that more people don't invest in real estate or they don't invest in other alternatives, which real estate is actually considered an alternative investment, which I think is bizarre because it's real estate, right? It's a real asset. It's actually something physical. It's not paper. But they've done a great job of sleight of hand of just kind of convincing people that it's real. So I think of anything alternative as just, anything outside of stocks and bonds, anything out of the traditional, hey, I'm buying this certain financialized asset that's a paper thing that gives me this. So it could be real estate, self-storage is a great one. You guys are doing an awesome job in that space. Precious metals is another one. We have oil and gas investing that I've done both, and I invest as a passive investor. I also invest actively in stuff that we do. We have our ATM machine fund, which I think we'll talk about in a bit. Yep. So there's other things, and I think the book I wrote, it was basically taking, I haven't figured out a title yet. Somebody's got a good title, let me know, but just the idea of like making money when you sleep, using alternative assets, and figuring out really whatever the asset is. It's not as important what the asset is, it's what does it do for you? What's the function of it for you? If you're a high earner and you're paying 30 to 50% in taxes, I think one of your number one things is how do I reduce my taxable basis? Well, there's investments such as energy, there's investments in other spaces that actually have the potential to reduce ordinary income for your spouse, and there's ways, I'm not a tax person, so don't, I'm not giving you advice, but there are things that can do that, right? And there's other assets that do other things. They provide capital appreciation or capital preservation or cash flow. So whatever you're looking at, again, there's a countless number of things. There's like insurance products that people have that they used to own that they can't afford anymore and they sell them off, and so then it's like a private equity thing and they do that. There's people syndicate car washes and car lots or like parking lots, and all. So there's so many things out there that it's hard to even mention. One of my favorite strategies, I will say real quick, is it's called a private equity roll-up strategy. This is something we've done with car washes recently, but basically it involves, and you'll see this with dental practices and gas stations and car washes and different things, but one of these offices, and there's a lot of boomers that are retiring, so if I have a dental practice, I'm selling my practice, it typically maybe sells for 8 to 10 times earnings, but if you have 20 or 50 of these, they might sell for 20 times earnings. Mm-hmm. So there's a huge premium to have multiples of these together. Well, why is that? It's because private equity has billions of dollars. They don't want to buy your car wash. They don't want to buy your dental practice, but they'll buy them in a big portfolio. So our car wash strategies, we're going in and getting to the point where we have 50 of a certain franchise of car washes, and then we can sell them off at a higher multiple.
So under that, in 2020, Congress made allowance for the Department of Labor to permit 401k plans as the life cycle funds asset allocation can now incorporate private equity as an asset class. So your 2025 target date retirement fund is not going to include 20% private equity. Your 2055 very well may include 25% private equity because that asset is intended to not be drawn on for a number of years. So back to your comment by way of the private equity firms, absolutely. For sponsors that are looking to build a pipeline of assets that go through some kind of a life cycle, be it 3, 4, 5 years, if you can package together $200 or $300 million of assets that are now seasoned and aged, you've done the permitting, the construction, the lease up, and now they're ready to be sold, you get what may be a 3.25 cap rate as opposed to a 4 cap, just because you're selling $300 million as opposed to $30 million. So that's a thing. Yeah. It's a legit thing. And Investment Advisor magazine, I think it was August of 2020, ran a big article on that, and it's really exciting because you just get a lower cap rate because you're a bigger fish or you've got more assets. What would, if you were to, if you, obviously you're not giving tax, legal, or investment advice.
Right, no advice.
Full stop. What would a best practice look like for an asset allocation from an ideal perspective? I mean, can you even speak to that?
Yeah, so it's a good question. I have a friend named George Gammon who talks a lot about economics, and he has this 10-80-10 allocation. And the challenge with as an investment advisor is that when I was an investment advisor, the allocation is the hardest question, because it's like, if you're doing syndication or other things, we can't tell people what they should do or what their allocation should be to certain assets. But it comes down to what they can tolerate, what sort of risk they can tolerate. What's in the investment world they cover what's suitable, and I hate the word suitable. Suitable is like okay, what's acceptable for your risk tolerance? And I'm like, who wants like a suitable spouse or a suitable vacation? Or what I'm saying, like, it just sounds terrible. Like here's a mediocre investment for you. But anyway, my friend George Gammon talks about this where he goes to the 10-80-10 strategy, where he does about 10% of his net worth in physical metals. So quite a bit. Now that he's probably overweighted compared to other people in that. and then 80% in cash flowing assets that pay you to hold them. So you could say, oh, well, dividend stocks maybe, but they're paper assets. I don't like them as much because of the counterparty risk. But if you own, great self-storage, multifamily, other, ATMs, other things that are producing cash flow for you, then it gives you the ability to, you typically have an asset that is not only cash flowing, but it's typically is inflation hedged. There's some inflation hedge components in there because generally as rents rise, which they generally do, with inflation, you're going to see the value of those rise. And then the other 10%, so you've got 10 in precious metals, 80% in cash flowing assets that pay you to hold them, and then 10% in more speculative things. So these are more, and this is, again, I think if you have a higher net worth, if your net worth, north of 2 or 3 million. So for us, we did this oil and gas technology deal, very high upside in the deal. There's also a higher chance that it goes to zero, right? But these are investments that have a 5x, 10x, 100x type of potential return. And so maybe you've got 5 or 10 of things like that are, if any one of them pops, you've done exceptionally well, right? So, but the allocation question is, I think, one of the hardest ones to figure out. It comes down to you and your spouse. Sometimes one person's like, I'm super into, open all this stuff, and my spouse just is not at all, and only does annuities or whatever. And it's like, play the sad music or something.
Good luck with that one.
I know, it's tough. So, so you got to kind of be on the same page with that too. But yeah, it's interesting.
Yeah. For those of you listening online, if you do have a question, do feel free to put it in the chat box. Does anybody here have a question on anything that we've covered so far? And if not, okay, let's pivot then.
You got a question right here? You got a question?
Oh, I'm sorry. Did I miss some?
Would you be able to tell us the name of the physical gold, silver vendor?
Yeah.
So let's repeat the question.
Yeah. Am I able to share a specific vendor?
The name of a security is irrelevant. Yeah. I mean, it's important, but irrelevant. Yeah.
Yeah. So there's a precious metals dealer called American Gold Exchange that I use to buy physical metals from. They're based in Austin, Texas. The guy who runs it was a president of the Numismatic Gold Association, so it's called American Gold Exchange in Austin. And then I have it shipped there's different vaults out there. There's one that I use is called TDS. It's sort of like transit depository systems. There's multiple locations. There's one outside of Vegas, and they ship it there, and then you can borrow against it. They have a sister company that kind of loans against it. So TDS Vaults is where you have it sent to, and then American Gold Exchange is a good group. So
now I'm getting like an image of an armored car packing around like 400 pounds.
Yeah, right.
Fun.
You don't carry it on you, right? It's too heavy.
Don't do that. Okay, so we started really granular at the beginning of our talk. Now let's get, we started broad. Now let's get granular.
Yeah.
Tell us about your past experience with ATM investments. What's your outlook going forward? Just go for it.
Well, I'll be really honest. When I first heard about ATM investing, I was like, I just was so turned off. I was like, well, who uses ATMs anymore? And like, if there's a scam, it'd be like ATMs. I just was so like skeptical of it. And but I had some friends. I had a couple friends that have done it for 5-10 years. The one who had done it for over 10 years, I really trust in my life. They literally have done more diligence on this deal, or they're the kind of person that you would trust with their life. Hey, here's the keys. Like, just take, And so, so after them talking about it, I kind of started digging into it just as a passive investor. And so I decided to invest, and I really enjoyed it. I really enjoyed how consistent it's. To me, it's the most predictable monthly cash flow investment that I've seen. Our group, we're not pitching any investment here, but it's a solid operator. We haven't, the group I work with, they haven't missed a single monthly payment or reduced the preferred return in over 10 years since the inception of the fund. And it's just, when you have things, it's typical, 8-10% preferred in multifamily. This is like over 20% preferred, so it almost sounds like, how is that never even right? Like, what even happened? So you look at this particular deal. The IRR is good. You get paid predictably, consistently, and that's one thing I've been really grateful as an operator, that you raise money for deals, for multifamily, for other things. I know a lot of people that are smaller operators, you get a little bit of money for the acquisition fee, maybe a little bit of cash flow, maybe, if you don't have a pref, and then you get paid a bunch at the end. For living expenses, a lot of the money that we had that was in some of our bridge debt, the cash flow kind of started lowering the last 12 months, right? And so as I started doing more ATM stuff, and we've raised close to $10 million for that the last 12 months, it's just been seeing that consistent cash flow. And so, it's a great strategy for somebody if they don't know what to do with, I'm going to have this money sitting here. What do I do with it? Well, to get half your money back predictably within, a couple of years or so, at least historically, nothing's guaranteed, but that's a unique option. So again, it has a cash flow element that I really like, as opposed to just a sole appreciation component. So it sounds like your guys' funds you guys do that as well with your self-storage. You have a cash flow component. So, but this is one. It's more cash flow. It has a lot of depreciation, and but again, I did a lot of diligence on it, and I've been really enjoying being a part of it. But one thing that, again, kind of my first objection was, who uses ATMs anymore? How many of you used an ATM and paid a fee in the last few weeks or month?
No.
Good one. Okay, that's surprising. I haven't probably paid a fee at an ATM in years. But the people that actually are using this, it's about 5 to 10% of the population. They're going every week. It's people that are the unbanked, the underbanked, immigrants. There's people, if you get paid cash under the table, it really is the bank for them, right? And so now even government benefits come on a debit card. So there are people using it all the time, and a $2 or $3 fee is just part of life. So we're seeing the usage, even during COVID, since COVID, being very stable in that world. So again, it's something I had to do a lot of digging into, but once I got into it, I was like, oh, I can see why. And it's also another thing, it's an unloved sector in the financial world. So it's very similar, like on the West Coast with the cannabis space. Cannabis, I think, is legal here, where it's, and I don't invest in the cannabis space, but in California, I don't know how it is here, federally it's illegal, but it's legal in the state. So there's a lot of issues with, to rent a place, there's a risk for the owner to have that person there, so they've got to pay way more in rent. If they have cash, banks won't take the money because it's not necessarily legal. So ATMs, it's not that it's a legal thing, it's more that banks like Chase Bank can't do it because it's a cash business, and there's the anti-money laundering stuff and these provisions. So it's kind of in the same group as like title loans and pawn shops, unfortunately, is how they evaluate it. So that's why the opportunity exists as well.
So one thing I like about storage is when when GDP crashes and people go through life events, there's an occupancy surge. How would the ATM asset class, where's the stomach that can get punched in that asset class? What would it look like for things to go wrong?
Yeah, so every asset, and this is something that I've learned over the years, is every single asset you invest in, there's always risks to it. And there's usually one or two primary risks. And I think, and if somebody ever tells you there's no risk, it's guaranteed to just run, because there's always a risk at every investment. So this one, I would say the primary one is, will people stop using cash? I think that's the biggest one. Will we go to a central bank digital currency? Will cash go away? Will people stop doing this? I personally think that it's highly unlikely for a couple of reasons. One is, politically on the right, people would say, I have to have some privacy so that the government's not in my business. They don't know what I'm doing, right? I got to be able to, so that's why, so there's no political will there. On the left, they would say, well, if we did away with cash, who would this hurt? Well, it hurt immigrants, it hurt low income, it hurt cash, it hurt all the people. So there's no political will to do that, right? So that's, I think, the biggest reason. And then I think also too, no country in the world's really ever done it. China, I think, is trying to do it, but that's a very authoritative type of government. And then there was one other thing when it comes to ATMs. I was going to say, for at least for the fund that we do, it's a 7-year investment that we work with, but it's really, the payback period is projected to be just over 4 years, and when you count the taxable benefits, it's about 3 years. So when you count that, it's like, well, in the next 3 years, is this going to happen? I think it's unlikely that cash is going to go away.
Yeah. So what are they doing behind once the investor has made the investment? Where's the money going? Is it setting up new ATM machines at new 7-Elevens or at,
Well, there's some benefits of this, because the money goes to buying physical ATMs in new locations. So whether it's 10 grand or whatever, we'll go to, it's really interesting how the business actually works, is that there's a split between the operator who operates the ATMs, like our partner, as well as the location. So the location will take, usually it's a 50-50 split with the cash fees that come from that. So what we'll do is, once, these ATMs every 7 years, typically they're out of contract. So when they get closer to the end of the contract, you have 6.5 years, we'll come and say, hey, how's it going with the ATM? Are you guys happy? And of course they're happy, they're getting paid. So we'll just say, hey, we'd love to get you a new ATM, but to do this, we've got to have you sign another 7-year contract. And so then they do. So then that cash stream is secured for another 7 years. We also, in this business, our partners they acquire other smaller operators, because there's a lot of mom and pop that have 500 ATMs in this market, or 1,000 in this couple markets. And then when they do that, there's an incentive to go in and want to very quickly extend that contract and put in new machines. So one of the benefits of that, because you're buying equipment, versus investing in real estate. Real estate has depreciation, but you typically have a recapture event when you sell, particularly multifamily, right? A 5-year, maybe you accelerated the depreciation all to year one, but if you sell in the 3rd, 4th, 5th year, you got to recapture whatever years you didn't use. With equipment, it depreciates to 0. So you get an 80%, at least in 2023, 80% depreciation year one. The remaining 20% is in the next few years. So it's got some cool taxable benefits too.
So does anybody, if we have a question, I'd like to repeat the question so the online audience can hear, but does anybody in the room have experience with ATM investments? We got John in the back. We got, John, can you just paint a 2 or 3 sentence perspective for us? So for those online, John has invested with Bronson in 2 tranches, glowing review, consistent cash flow, never a hiccup, and
yeah, and I paid him to say that, I guess. I don't know.
I don't.
No, I'm just kidding.
I know you, and I don't.
We have had, though. I mean, there's unique examples where, again, this is more of a tax strategy piece, where we've had several investors invest around $1 million each, just in this type of thing. Usually, it wasn't all at once; it was over time, and I'm sure you've had that too, where someone dips their toe in and they get more in. But because of we had a couple guys, brothers, sell a business, a medical practice in California. The tax bill was $2.4 million. And they found a way to get it all the way down to $125K. It would have gotten to 0, but they got it there in California. They don't recognize certain depreciation, but but the idea of having depreciation that you don't recapture, that was really attractive. So anyway, again, we're not here to pitch any deal, but I think as an investor or as an operator, it's just really important you look at what are the parameters of what this does and who would this benefit, and would this benefit me, and if not me, would it benefit someone else? And that's a way too that you can provide value both as a friend, as a passive investor, or as an operator to help provide value that someone else isn't providing.
Yeah. That is cool. Okay, so any last questions on ATM? Oh, we have one in the back. Why don't you repeat that question?
Yeah, so the question really is, how do you do market research to know where ATM machines should go? This is something that our business has evolved a bit to go from, we're operating a lot of stuff to where we're not operating really much. I mean, this is a partner that does a lot of this. So this is the 4th largest operator of ATMs. We're talking over 50,000 ATMs. So they have it down to a science of, where are the potential spots for ATMs, who's there, how do we approach them, keep track, the salespeople keep track, when is this one come out of contract, and then they make sure that so you're trying to win those over and stuff like that. But there is a lot of, they'll have traffic patterns of who's in a certain place. Of the fund, it's interestingly enough that most of the locations, about 99% of the locations, are existing locations. So when we have investors, it's not like we're going into new locations. These are already existing locations where we're extending the contract, so that's been a very successful strategy. And then you'll pick up different accounts, and people say they'll call someone else, or a buddy who runs maybe it's a bar and somebody else runs a bar. Hey, you should check out our guys; they're really good, whatever. And so we'll get some referrals that way. But yeah, as far as locations, most of these are existing locations, because most places that have an ATM or could have an ATM machine, usually they have them, or they're going in a new build or something. And so we just try to be available. But this fund that we're involved with is in 6 different states, including California, New York, and some East Coast states as well.
So just a follow-up question on that. When you say you're basically investing into the existing ATM machines network, so does that mean that you're basically taking over the previous investors in that because previously, that's how it is? So
it's an interesting, I have a chart on this in my book on how it works as well, because multifamily and real estate in general, you buy an asset if it's not a fund, if it's a single deal, you buy let's say it's an apartment building with 100 units, you buy it, you wait a certain amount of time, usually we do value adds, there's a certain kind of waiting period, then it starts cash flowing, and then you have a big lump sum at the end. You're hoping the asset is worth more than what you paid for it, right? So about half of the projections are just that it will go up. With ATMs, basically, it has a 7-year life cycle, and it basically depreciates to almost 0. So again, you're getting paid out consistently like this, and then you get paid out for those 84 months, then the preferred return stops and the investment ends. So you're out. So there's no big lump sum. There's a small scrap value at the end, but there's no big lump sum. So that's all calculated into how the investment is paid and how that works So it is structured a little different. Yeah, so it's more.
How will the depreciation work for the next set of investors?
Yeah.
Because the ATMs have already appreciated, right? As you said, to zero value.
Uh huh.
So when the new set of investors come in, right?
Yeah.
They don't get to take advantage of depreciation.
Well,
And let's repeat
Sure.
the question.
Yes, the question is about depreciation. How does the new investor take advantage of depreciation if there's new equipment or it comes up? So basically, the way it goes, I'll just explain this real quick, is that with this fund, is the equipment is purchased. It takes a few months to kind of get them purchased, get them kind of up to speed and into operation, and then 30 days to actually have them start accruing cash flow. So it usually takes about 4 months before cash flow starts, and then it pays out for this 84 months. And then at the end of it, it's decommissioned here. So you can, if you've depreciated to zero on this, when you go in now, you're kind of where you were here, right? Where you're going back to that bar or that gas station, whatever, and say, hey, how's the experience going? Can we get you a new ATM? So that's happening again in 7 years. You're putting a new ATM in there, that's a new investor that's taken over that spot. Now, we don't do it as, hey, this is your 5 ATMs, whatever. It's a diversified portfolio. But it does work that when people come in, they do get that depreciation every time because it's diversified. But each cash stream is considered a 7-year cash stream. Does that make sense? Okay, we can talk offline too if you have more questions about that. So
Yeah, we can.
Okay.
Okay, so last question. So how did you vet the fund that you're participating in, and then we can apply that same knowledge to how does an investor vet a sponsor and some of the focus areas there?
Yeah, it's a good question. So I think I basically in my book I'm talking about this as well, where you have the whatever the asset is, you have the market for that asset, you've got the operator, and then you've got the deal. It's like a funnel, right? So if you're in the right market, so we buy a lot in Jacksonville, Florida. I love Jacksonville because 1,500 new people are moving there every single month. Actually Ed and I were out in Jacksonville about a year ago hanging out, which was nice. So you're looking at what is the market. Because if you buy in the right market, you can do a lot of things wrong and you're still in the right market. It's going to still go okay, right? The right, as long as the population is growing, that kind of thing, at least when it comes to multifamily. Then it comes down to who is the actual person operating this. Do they have experience? Are they reputable people? Is this a type of deal that they've done before? If they haven't done this before, maybe they're great over here, but it's not really in their wheelhouse. Well, that's something to consider. And the reputation. And again, reputation, everybody, especially when you're in the industry, everybody kind of knows everybody's stuff and word gets out on how people do and that type of thing. And then the bottom part of that funnel really is, what is the actual deal? What does it return? What are the risks there? What are the assumptions? Is it conservative? We see in multifamily, a couple examples are what rent growth assumptions are they making? Are they assuming that rents are going to go up, 5 or 10% per year, even though we've seen huge rent growth? Maybe more now. It's like no rent growth or 1% or very minimal. And then also with the cap rate at exit, because you change those two numbers, you could go from a 12% return to a 25% return just by making small changes on those numbers. So that kind of goes to the conservative level. But for the ATM fund, what I did, again, I invested personally, and then when I was thinking about getting investors involved, I background checked all of the partners that are actively involved in this deal. I flew out to the area. Really ask some hard questions, try to really make sure I understand, how does this work? What are the reasons why we want to do this? What are the biggest risks of this investment? I think that's a really critical question. Like, how could I lose my money? Like, rule number 1 of investing, Warren Buffett says, don't lose money. Rule number 2 is don't forget about rule number 1. It's that important. If you just can avoid losses in your investing, you'll do really well. So asking those questions, and then basically just continuing to, I looked at some of the operations. I actually got a list of random ATMs in Pennsylvania and went and started just making sure everything was labeled correctly and everything was in the right spot. So I feel like I did some extra diligence there. But, I think it's different as a passive investor. I think having, somebody who's invested before, that adds a lot of credibility, somebody that somebody that when you talk to and you listen to them, that you feel like they've got a good sense of, just a realistic approach. And again, I found investors, I used to think investors wanted to have a higher return projection, but actually really I find sophisticated investors actually prefer a lower, and we talked about this, Drew, when we're working together, having a lower, projection, instead of a 17, 18% projection in a big metro, maybe it was a 12 or 13%. But then, by the way, there's all these things that we didn't include in the projections are potential upsides, right? So then it's like, it kind of feels like there's a margin of safety, which is another, you can't tell like Warren Buffett, but it's another Warren Buffett term as well.
So a question came in online. What is the demographic of the investor who's investing into this type of an asset? What is that?
ATM fund specifically? Yeah. So I mean, it's a variety of people. We get a lot of people that it doesn't have a high minimum investment. So it's not a substantial investment to get started, and then people. But it's typically it's accredited investors only. Again, we've had some people that are very high net worth do it. Some people that kind of dip their toe in, and it works for them. But again, I think when you're looking at investments, is what in my portfolio provides cash flow, and what's really going to give me the type of return. We had a guy who put, about $500K just for his kids. A wealthy guy put some money in for his kids because he had these accounts. He's like, I don't know what, I'm sitting in the bank and I've got it. Like, what should I do with this? Even retirement accounts. Sometimes people put retirement accounts with that as well. And because it's not leveraged at all, it's a cash thing. There's no interest rate risk, which is a benefit. It also doesn't have any UBIT tax in a retirement account, which is a unrelated business income tax, which if you use leverage inside of a retirement account to buy real estate, they can tax you on that, which is really sneaky, but the IRS loves doing that stuff.
One other question online. What areas are of interest to you for investing in the alt space?
Gosh, I'm super interested in everything. So if anybody has a deal, send me. I'm interested. Yeah, I think right now I'm probably overweighted precious metals just because there was a time. Again, I don't look at that as an investment. I look at it more as a store of value, which I think are different. It's almost like instead of holding cash, I hold that. Mm-hmm. But there was a time when between 1974 and 1980, gold went up 25x. So I mean, this stuff does happen, and so I think there's some stuff there. I love real assets between multifamily, self-storage. I mean, even short-term rentals. There's all kinds of creative stuff out there that can make sense. We're doing stuff in the oil and gas space. I'm super excited about that, both on kind of long-term cash flow stuff, and then we have other stuff around that that's kind of some technology around oil and gas. So I think the biggest thing about alternative investments is being well networked with other passive investors, going to events, and just asking questions. And because the people that I know that are finding the best deals, these are not ones that everybody hears about. Yeah. They're ones that you heard about because you have somebody that is really creatively brought you into something.
Knows a gal, knows a guy.
Yeah, like I know someone who's doing an international trucking logistics business where investors get paid like an 18%, it's like a hard money type of thing, but it's like 18% annualized, and I think it pays monthly. Like, so there's things out there, like I'm not endorsing that or anything, but I'm just saying there are these deals that we hear about that are so creative, and it's just like, oh, that's really interesting. And it doesn't fit everybody's profile, but for some people it really could.
Yeah. And of course, the old adage, do your due diligence thoroughly. Ed, did you have a question?
One question, based on what just was said. If you had a couple $100,000 dry powder to invest, today's market, given that, and you think that we're heading for a recession where gold might shoot up in value, but it's only a store of value, would you take that money towards gold, or would you say, you know what, I can get a 25% discount on a multifamily building or a storage mom and pop building, I'm going to take it there and go try to invest it in that business and make that grow?
Yes, the question is dry powder. If I got 200 or 300K dry powder, would you buy gold? Would you buy a real estate asset? And I think my brother's going to laugh, but it depends, right? It was like, there's this quote in a movie where this guy says, no, I wear depends. So it's a funny, ridiculous quote. But anyway, I think it really depends on your situation. It depends on what your goals are, what you're looking to do. For me, I think if you don't own any precious metals, I think it would be interesting to start maybe getting some. Everybody has a different level of comfort. Not everybody wants to do lots of different alternative assets. Not everybody's interested in that. But I think that a lot of times I don't learn unless I invest something. So it might be something to say, hey, I'll maybe take some of that and put it in metals, and I'll put some over here and here and here. And I really think that, I've had 1,500 one-on-one phone calls with high net worth investors, and one thing that's come up is that, it's not just the investment. A lot of times we're like, well, how's this investment going to do? How do I not lose money? Really, I think the goal should be is, how can I learn from this? Like, if I learn this skill, if this ATM or this your self-storage fund, or this, if this investment goes well, what could develop? I mean, could this be something that I start putting more and more of my resources into if it actually delivers the way it's set up, if the way it promises? And not every investment does. You get an investment, and it's like, oh, it didn't really kind of go the way I thought, or
No.
I didn't really like the way that I felt when I was in that, right? So I think paying attention to all that stuff too. And so some people love certain things, and some people like, you know, somebody, and these are like really, really smart high net worth people. And like, why would you ever do this? I have friends, I used to be totally anti-crypto. I still think crypto is, you know, it's an interesting, I like that it's outside of the financial system, but I don't think it's a great store of value. But I have friends that absolutely love, have a huge, you know, high net worth, like 50% of their net worth in crypto, you know, and I'm like, okay, well but that's not me. But then other people I know would be like, oh, it's a total scam, why would you ever, so I think you have to kind of find your own opinions on what you feel you should do and what you're comfortable with. And the goal is really, it's like developing, it's like going to the gym and training and building a muscle. So that, you know, I can do this in the future and I can put more money to this and it will return well for me.
No, that's a good answer. That's a thoughtful answer. So I think we've got it wrapped up for the day. Bronson, thank you for coming to Seattle from California and sharing your thoughts and your wisdom with us. We're going to cut it off here. Plan next month in May to not be here on First Friday, as we're going to pivot and pick up a weeknight, maybe 5:30 or something like that, where it's okay to have a beer and visit and hang out. So anyway, thank you for joining us, and we will see you soon. Thank you again.